guys, Ron Parks here, and welcome back to the channel. I've invited Elliot Elbaz here today, a good friend of mine, and also a wealth manager, to join me so we can talk about money management. Now, don't worry, we both have been tested for COVID, so we're safe. Elliot founded Gordian Wealth Management, which has offices in San Francisco and Palm Springs. So, Elliot, tell me a little bit about your background briefly, and a little bit about how'd you start Gordian?
Well, I've been in the investment profession for over 30 years, and I started Gordian in 2012 with the interest of investing. I've always been very fond of investing, and when the opportunity set presented itself, I realized I had a lot of friends in the Bay Area that worked at private companies. At the time, LinkedIn, Facebook, and a lot of them were disenchanted with the big banks, and I was, like anything else, went to one of my friends that was an early employee at one of the tech companies and said, I got this idea to not only manage money, but also to help families around all the other aspects that go with that. Trust and estates, insurance, tax. And in talking to them about that, they were so enamored that they said, okay, you can have my money, go set it up. So I had to go back and I had to go figure out a name, I had to find out partners, and it took me about 6 or 7 months to do. And we launched in November of 2011. And I wanted to do something also entrepreneurial because I really love the entrepreneurial spree, especially being in the Bay Area. And having 3 kids, wanted to be close to home. And so I set something up in Marin that was close to home.
Okay, great. So
and as you know, you sold me my first house.
That's true. And your second house.
And my second house.
And it's true. Elliot and I also know each other originally from my real estate background. I helped Elliot and his wife buy their first house in the San Francisco Bay Area when their child was really, really small and in a little bassinet, which I carried around, a newborn, which I carried around while we were looking at houses. So a lot of the people that are watching this video, they're interested in finance, they're interested in how to make a lot of money, or they're interested in preserving money. So people think of a wealth manager, and my goodness, they think of Bill Gates and Warren Buffett, and I have to have $1 billion, or I have to have $100 million, or $50 million. Is that true, or what kind of, how should people look at hiring a wealth manager, or at least thinking about exploring one?
Great question. So I think it starts with how comfortable the individual or the families are with what they have. There are some people that never look at it, and there's some people that are actively involved. I think there's a happy medium in between. And so I think at the point where it becomes too daunting is when you want to bring somebody in to help think through how to invest it, how to preserve it, how to pass it on to the next generation. And in certain instances, if you have a big charity, how do you want to leave a legacy? And so that's really the ultimate difference between a wealth advisor and a money manager. A money manager will just manage your money without all the nuances that go into what we just talked about. And that's, at the very high level, the big difference.
So it's not a holistic approach, hiring a money manager, but hiring a wealth manager like your firm is holistic. You cover a lot of different things that the client needs.
Correct.
So I want to talk a little bit about age groups. So I'm going to break it down between people that are between 20 years old and 30 years old. If they came to you, how would you talk to them about investing?
Well, if they're between 20 and 30, they're going to have a lot of years where they're going to be hopefully working unless they have a big windfall. But for the most part, people aren't going to retire in their 20s or 30s. They could. But I think what we want to think about is by being invested in equities over the long term have really proved to be a worthwhile endeavor. And so I think, right now rates for fixed income and bonds are pretty low. And so I think the question becomes is what we would do with them is sit down and create a plan. And we would have a plan that would be, if you're 20 to 30, the mix would probably be closer to 70, 30, 80, 20, 80% equities, 20% fixed income or some alternatives that are fixed income like, and that could represent being an investor or buying into a multifamily or real estate, things that have a little bit more yield and a little bit more protection from a taxation perspective.
So what kind of assets are we talking about that someone would really want to have a wealth manager if they're 25 years old?
Well, that's a good question. So you could be 25 at a company where you've been there for 3 or 4 years coming out of school, and in that company is, while it's private, you might actually have a windfall in stock because you've earned stock options are actually stock. So I think it just depends on the individual with their comfort level with working with somebody else. And I think once you get to a level that's probably $1 million or more in liquid net worth is when you would want to bring in a wealth advisor.
Okay, great. So here's really a question I've always thought about, and I didn't have an answer. Like, why would someone go to like Morgan Stanley or Goldman Sachs or Charles Schwab and have them invest their money versus going to a more boutique firm?
Another great question. I think in the past, there has been comfort level with brand names, right? So I want to say 10, 15 years ago, those firms had a lot of cachet. They fell out of favor during the great financial crisis. And a lot of those financial advisors, money managers left to start in kind of their own firms. And that's really where we started, where I was working in a related business, but not as a wealth advisor, and had a lot of friends that were disenchanted with the big banks. And so what we do in terms of the holistic approach is we are on those platforms. We are, we have access to Goldman and JP Morgan and Morgan Stanley, but we're agnostic. So when we look at something like a mutual fund or different investment vehicles, we can line up those different firms and see which one has the best fees, which one is the best manager. And so we are independent and fiduciaries that, as opposed to working for those individual banks and being siloed into that product group.
And potentially being pushed into some of their products.
Correct.
Right. Now, it is true that people who have, let's say, just starting out or have limited assets, the first thing they should do is, set up an emergency savings account so they have it. And the second thing they should do is put some money in some investments. But if they're just starting out, I think that might be one of the reasons why they go to the big firms who have very, very low minimums of deposits. Is that right?
Yeah, you've got Robinhood, where now you can open up an account and trade for free.
Except you can die from that, because you've read that a 20-year-old who was trading on Robinhood, he didn't realize that he was trading options on margin. He ended up having a loss of over $700,000, and he killed himself. That's an anomaly, hopefully. But there are platforms, yes, like Robinhood, and I'm sure there's other ones, where you commission free and you trade for yourself.
Well, a lot of the firms now are basically commission free. So Fidelity, Schwab have really kind of led that charge, TD Ameritrade. We happen to partner with Charles Schwab, which we think is kind of one of the best.
Okay, great. Okay, so we talked about people between the 20s and 30s. Let's talk about now people between 30 and 45. I'm assuming the difference there principally is that they have more money.
Typically,
hopefully.
Right.
Yeah. But their time frame and horizon, let's say to retire, is getting closer than a 20-year-old. So you would allocate their portfolio differently.
Yes, and I think when you get into that age group, they are either dinks, dual income with no kids, or they're dual income with kids.
Would you say dink?
Dink, dual income, no kid.
Dual income, no kids.
Right.
Okay.
That's kind of like the new yuppie, right?
Yeah.
And so when you get into that, they're either planning to have kids or a family, or they've already had kids. And so I think thinking about college, thinking about all these different components, making sure that they have disability insurance, or making sure that there's some kind of insurance there in case the breadwinner, something happens to him or her. And so I think we can add some perspective. Our firm tends to be a little bit more boutique, but we can also, the benefit of being with a wealth advisor is you can also leverage what some families are doing within your same age group or your same, what we call zip code financially. So we can share and say, some insights on what strategies are being used or implemented at the time.
I've heard people say that it's really very, very difficult to beat the market. So if the Dow or the S&P 500 is increased by 11% and you try to do it yourself, what's the chance of you being able to get more than what the market did?
That's another great question. So up until recently, passive investing, which is investing in indexes, has been a very good place.
So you're talking about index funds, and index funds would be something like the S&P 500 or the Russell 2000 or the NASDAQ 1000 or any of those.
Correct. Mm-hmm. And what's happened over the course of the last 3 or 4 years is that they've gotten very heavy weighted towards a select few type of names. Between Facebook, Apple, Google, and several others, they account for 25% of the index. And so everybody owns Amazon, everybody owns them, and those have been kind of all going up. I think where we think there's a paradigm shift that's happening is that we think while money managers, which have been actively managing money, have been out of favor, I think that's going to be much more in favor now when we're in the COVID, and understanding different businesses that will survive COVID, that will flourish or that won't flourish, and having someone that's actively managing that portfolio.
Because it is really, I think, almost impossible to, as an individual who has a job or has a family and doesn't have the background in investments, to go pick and choose different stocks to try to see how they can do in their portfolio. It seems quite risky to do that.
Well, I think the easiest is to buy the indexes and just participate, right? That's kind of cheap and easy. But I think as we get into a more complicated world, and I think if someone's net worth becomes more in a zip code where they're going to need some help, I think having someone to be able to identify, for example, when you buy equities in an index, how much do you want to tilt towards growth? How much do you want to tilt towards value? How much do you want to tilt towards large cap, small cap, mid cap? And in any given period, there are parts of the market when you kind of subdivide it between growth and value, large cap, small cap, mid cap, that all perform in their different relevance. And so what we're seeing today is that growth has had a big move, and people are paying for that because they feel that it's going to be able to continue to grow and there's going to be some big tailwinds. But what's been left behind a little bit has been value. And so we tend to, as families come to us to want to preserve, we might be rotating or tilting the portfolio from a little bit more growthy to more value, as we think that there's better opportunities in that subsector. Also, small cap has been really hit hard, and we think that small cap, especially picking a small cap manager, has been very hard to find. We've identified a couple and that we're very excited about, and I think that will actually bode well in the next 6 to 12 months.
Great. So Elliot, you probably won't be able to answer this, but this is a question that I think a lot of people have been thinking about. If we have 30 million people unemployed and businesses have partially shut down in the country and economic growth has decreased, why is the stock market going up and so high?
Well, that's a function of the old adage, don't fight the Fed. And so what the federal government has done is, in the initial crisis that happened in late February, early March, is the credit markets seized up. And so they very quickly, taking a page from 2008 and 2009, were able to create liquidity to be able to free up some of that fixed income that was really kind of congested.
So they opened up their checkbook.
Correct.
And supported banks, investment funds, whatever types of vehicles needed to be supported.
So that was one, and then it was a dual-pronged approach between the Fed and the Treasury. And so they very quickly kind of, for example, moved on a PPP program, or pushing out your taxes that were due in April to July. And so they really collectively were able to intervene to dampen the shock of what we're seeing.
So you're in touch with all your portfolio managers pretty often. So what do you feel the trend is going on with the stock market?
Well, the trend has only been one way, and that's been it's been a V-shaped bounce in the market. While everything that you're reading and seeing is that, yes, unemployment had several months of dramatic pickup, but I think there will be systemic damage to certain businesses or families that will kind of come from it. And so I think it's going to be a little bit more murky. It's going to be a little bit more wait and see to see how, for example, we're about to go back to school. And right now, California yesterday put out a note that says that California public schools aren't going to be in school.
Right.
And that's going to put a strain on working families.
Right.
And so how all that plays out will also be a kind of wait and see.
Right. Okay. Well, that's great information. So the stock market is not the only avenue to invest. There's alternative investments, and what would you consider alternative investments to be?
So alternatives are anything, for example, private equity, venture capital, hedge funds, looking at real estate, so investment properties. And so there's a whole subsection that when you layer those into a portfolio that really kind of are the shock absorbents. So when you saw the big drawdown in the market in February and March, if you have an investment property, for the most part, the property value didn't decrease or the rents got paid. So those kind of assets help in what we create pillars so that they become buffers when you have these big shocks in the market that are more liquid.
Right. But as you know, I still do real estate as a real estate broker. And I can tell you for a fact that certain areas of California, which I sell in, there hasn't been any decline in prices, and sometimes there's been an increase in prices. But that is location specific in general as it relates to how prices have been in housing. I would think that in certain areas of the country where it's less desirable to live, then you probably will have much more of a pressure on a decrease in prices.
I mean, you would know better than anyone that you're seeing based on remote working.
Right, people are not going to the office anymore.
And so people are able to have the flexibility to kind of work from anywhere. And so that's really opening up opportunities outside the large urban cities.
It's not just working from home. It's that I can't tell you how many people have called me and said, I want to get out of the city. I want to go to the suburbs where I'm not on top of everybody. And this is a result of the COVID. But a lot of people who have young children, eventually they leave the city and go to the suburbs, basically to give them more fresh air, more outdoor space, and better schools.
Yep. And so let me just highlight a couple of things that we're looking at that are kind of interesting. One is we are working, for example, with a real estate group that is a debt group, real estate debt, and they're creating a special fund for distressed assets. So to your point, there might be opportunities to look at, for example, hotels. Hotels for the most part are owned by individuals or groups that might not necessarily want to sell those assets at this time, but might need some financing to carry them through when people are going back to hotels and traveling. Offices, we think, might end up being in certain scenarios opportunities where there might be some distressed opportunities.
So you mean these funds are going to try to buy these properties at a low price?
They're going to do their homework to be able to buy them correct. For example, another asset class that has been historically very good during downturns were apartment buildings next to universities, because you've saved throughout the years to send your kids to college. Well, right now, as you know, some people that are getting freshman classes, I think something like 40% of the freshman class coming into this fall is going to defer. And so these apartment buildings that have been typically very high occupancy for kids in school are being empty.
Well, a lot of the universities are not letting people back in. It's going to be remote learning. So what's the upside if you invested in one of these funds that carry distressed properties?
Well, first of all, it's got to be right for each family, right? So we would go through to make sure that the lockup, the illiquidity part of it makes sense. And then from there, we basically making sure that it's, a certain percentage that's not overweighted, so it's not the tail wagging the dog, but making sure that we make lots of little bets so that it's a well-diversified portfolio.
Got it. So if you're going to summarize this and give some words of wisdom to the people that are watching, what would those be?
I would say that number one, most people, know if they need help. And so I think if, you need help, it's from our perspective, it's working with someone that you actually enjoy being with, right? I think that's the biggest part, is like having someone be able to explain what you have and what you're doing with it, so that it's not something that you don't understand.
Right.
And that's what I would say.
Okay. Well, I thank you so much for your time. I think it was very, very enlightening to hear about, and I appreciate the time.
And absolutely. And if you go to my website, there is an estate planning feature that you can kind of look through and understand the difference between estates, wills, trust. It gives you a little bit more background and videos on those.
I'll leave a link below to everyone so you can get the website, even though I'm not pushing any specific wealth manager, but I know Elliot's firm has a lot of information that could be useful. Elliot, don't you also have like a budget that you give to people to try to fill out?
Yeah, well, that's part of the first part of doing a financial plan. Mm-hmm. There's also, because 2/3 of our families are entrepreneurs, mm-hmm.
We
have a tool that's it's called the Knot, and you can go in. It's a little 90-second video that helps just get families organized, helps them get kind of everything centralized. So for example, if you have cocktail talk and you talk to someone and say, oh, I do have a trust or I do have a will, and they're like, oh yeah, it's in somewhere, we actually help digitize that and put it in a place so that it's organized
all together. Okay, so I'll leave a link down below also of the Knot. Well, I hope you found this useful, and I really thank you all for listening and watching. And if you really enjoyed the video, I would really appreciate it if you can smash the like button and subscribe. And until next time.